Mr. Pope. Mr. Pope.
Yeah, I'm with you. I don't dey expect this voice tey.
Yeah, here again today. Uh, okay, let's move straight into it. Good evening, everyone. Hope we all had a beautiful day, but I did not share. There was protest in my city, so it was not really that nice. But
You
uh,
can start it. You can share your screen so that's
no problem. So we can I've shared this corner. So sorry for this. Sorry. Okay. So I was asking if all had a lovely day. So let me open something here. Please don't let us forget the rules. As you are coming in, please mute your mic and mute your mic as you are coming in, and please do not unmute until further notice, Abby, something like that. So once again, good evening. My name is Alan Shile. We stopped last week. We started portfolio theory last week, and we got to a reasonable extent. At least we did couple of things. So I will run through what we did again, like I always do, before we move on to like today's topic. So we started portfolio theory last week, like I said earlier, where I defined portfolio, where I said portfolio is like a collection of several instruments. Like you collect instruments like bonds, stocks, real estate, and shares and the likes. So that was what I defined portfolio as. And I said, like the topic says, portfolio theory. I said portfolio theory is a theory on how risk-averse investors can construct portfolios to maximize profits, maximize return. I explained risk-averse. So I said risk-averse are like me and Pope. We don't like to we always have try to avoid risk. We don't like to take risk that much. But anytime we want to take risk, we always take risk on to expect great return, to maximize return. Those are criteria where those are what risk averse means. So that is simply the definition of portfolio theory. It's a theory on how risk averse investors can construct portfolios to maximize expected return. So what that is simply saying is, I said portfolio is like combining a lot of things. You have bond, you have shares, you have stocks, you have real estate. How are you combining all of them to maximize profit? With what amount of shares, what amount of bond do you need to get so you'll be able to maximize your profit and reduce risk? Because as you're thinking about profit, as you're thinking of return, you need to think of the risk too. Because the more the return, the more the risk. We know these things. Now, the higher the return, the higher the risk. So you need to know how to combine your portfolio. So I've been saying risk. I also mentioned risk in our last class, where I said risk can be defined as the chance that investor's actual return will be different from his expected return. What that simply means is when you put your money somewhere, risk is the fact that okay, what you're expecting is not what you're going to get. What I ordered versus what I got. What you put there, your expected, what you want, your actual return will be different from your expected return. That is the risk of investing in such business, in such portfolio. That is the risk involved. And I said there are basically two types of risk, where I spoke about systematic risk and unsystematic risk. Where I said systematic risk now is a type of risk that affects all the companies or all the business in the industry. There is no it's not like it's affecting a particular line. No, it affects everybody. They affect everybody. And I said systematic risk are also they're also non-specific risk. They are non-diversifiable risk, they are unavoidable risk, and they are better risk. Examples of risks like this, I said COVID-19. COVID-19 affected everybody in every part of industry. It affected entertainment industry, agriculture industry, affected everybody. COVID-19, inflation, the way the country is now is affecting everybody. Pandemic, economic recession. I give like about 6 or 7 examples in our last class. Please watch the last video on our YouTube channel to get those informations. I cannot be listing them again. So I also explained on systematic risk, where I said unsystematic risk is a kind of risk that is peculiar to a particular company or industry. These ones are known as specific risk, unique risk, diversifiable risk, avoidable risk, or alpha risk. And I give example, I said regulatory change. Regulatory change was where I spoke about IFRS, where I said if I can't change a particular standard, it's just going to affect the accounting people line. The accounting line is not going to affect them whiskey, them Davido, entertainment industry is not going to affect them. It's just going to affect the accounting line and everyone related. So I said regulatory change, I said location, product recall, and I gave like 5 or 6 examples of that too. I think after that, I moved to portfolio diversification, where I said diversification is a risk. Please be checked. I don't know if you're checking your note to confirm all these things, though, please. I said diversification is a risk management technique. And I gave a layman definition where I said diversification is where I use Pope and I as an example, where I said Pope is the only thing he has is bond in his portfolio, bond in his portfolio. But me, as a sharp guy, I bought stocks, I bought shares, I bought real estate. So when bond is crashing, I have bond too. So let's say bond crashes, it will affect Pope so much, but will not affect me because I have other ones that I can use as backup. I have shares, profit from shares, I'll use it to cover up. So I said portfolio, it prevents investors from having a disastrous end, from having a complete disastrous end, which means that if your bond fails, all your investment has gone. But me, if my bond fails, I have other ones to fall onto. That was what I explained diversification as. I said, according to ICANN, we have 3 types of diversification. Which is what is on my screen, where I said horizontal diversification, concentric diversification, conglomerate diversification, and I explained each and every one of them one by one, which I said horizontal diversification is when like you're offering a new service or product to satisfy your customers. Like you're offering a new product like that is different from what you are presently doing, from what you are presently offering. I give an example. I give plenty of examples that day. I think I spoke about Afolabi Felix, please, I'm coming. Where I said, I gave example, I used Biggie Cola and the likes, for example. I used Biggie Water and the likes, for example of that. I spoke about concentric diversification too, where I said, you are adding a new product and related product to the existing one. They are still related to the existing one. Let's say the example I used that one. I said the way Biggie was producing Biggie Apple, then they now decided to add Biggie Coke or Biggie Fanta. It's still on the same line. They are still going to use the same machines. They are just adding a new product to the existing ones. And I explained conglomerate diversification. This one I said it is when you are adding a new product that is not even related to what you were doing at all from the beginning. Biggie Cola, Biggie Car, Apple decided to go and do Biggie Car. They had to go and do Biggie Toyota or Biggie Camry or Biggie Lexus, something like that. So they are moving into a different industry entirely. That one, they cannot use the machine we're using to produce Biggie Apple, to produce Biggie Car. So those are the types of diversification that I explained. Afolabi Felix, please, I'll attend to you, please. So I spoke about portfolio risk, portfolio return, where I gave you all the formulas needed. I snapped and sent to the group. And I explained what each and every one of them means or means, yes. I explained for individual security, for 2 assets portfolio, I gave formula for the risk, and I gave formula for the return for the individual security, and for portfolio return. I gave their formulas too. I gave formula for correlation coefficient, which is needed when you are calculating your risk for 2 assets portfolio. That I don't know if you are looking at your book, Sha. If you are, fine. If you are not, I don't know how to help you. So for portfolio risk, for the 2 asset portfolio, I gave a formula. At the end of the formula, there's something like Rx and Y. That Rx and Y stands for correlation coefficient. Correlation coefficient. So your correlation coefficient, I gave you the formula to calculate it. How to calculate your correlation coefficient, which is your covariance of X and Y over standard deviation of X and Y. I gave you formula to calculate covariance 2 in our last class, and I explained what each and every one of those formulas meant. So I said, what we are starting with today is correlation. So we'll do correlation. Please and please, we need to move as fast as possible. I'm planning to go if I cannot finish it, at least I should be at the ending stage of portfolio theory today. So in our next class, people have been asking me about option a lot. I've had 1 million DMs about options. Please and please and please. It's good to read ahead. It's very good to read ahead. But there are some topics that you will not just understand them. You will not just understand them. Looking at the path, because if you are doing options, you have to go and look at a normal distribution table. Most of us here don't even know how normal distribution table works. So for normal distribution table, we have half table and we have full table. If you are looking at full table, you not get, some of us read with pathfinders. We go to pathfinders, we go and try to know how they solved it. In pathfinders, you can use full normal distribution table. But if you check it, if you are checking your own, you'll be checking half distribution table, and it will not correlate. You just be giving yourself unnecessary stress. It's good to read that, but the one you don't understand, move on. When we get there, we'll explain it to you. So our next class will be doing options, but we need to move as fast as possible for portfolio theory today. So before I go to correlation, let me answer Afolabi Felix. I don't like the fact that you raised up your hand. And so Afolabi Felix, please go on, sir. Afolabi Felix, Olalikon, you raised your hand. Okay. Please, can I'm with you, sir.
Maybe it was a mistake. If he's not talking, then maybe you should continue.
Mr. Afolabi Felix, I'm with you, sir. Okay, I'll take it that he's not here, or he's not, maybe it was a mistake or something. So please, let's continue with our class. But please, everything I explained and everything I said, is it as it is in your notes? Before somebody will say, I'm speaking too fast. Sorry, I'm just doing a recap of everything I said in the last class. I don't know, I already spoke about everything. I took time to explain them in the last class, but I would slow down a little bit, sorry. So please, is there any modification from anything I said? Or somebody has Googled something and found out that what I explained was wrong? Do you want to like bring anything up? Is there any question or any observation before I go to the topic of today? 1, 2, 3, 4, 5. So I'll take that as a no, yeah? Okay, Joy. I think Joy, you're raising your hand.
Good evening, sir.
I can't hear you well.
Good evening, sir. Good evening, everyone. Can
Okay.
you hear me?
Yes, I think
Can you
it's
hear
better.
me?
Yes, it's better now.
Okay, please, what's the difference between stocks and shares? Thank you. You hear me?
Daniel.
Please, can anyone hear me?
Yes, sir, we can hear you.
I think I got disconnected. Mrs. Joy, please, you were asking me something.
Yeah, she was asking the difference between shares and stock.
Mrs. Joy, I can't hear you.
She was
asking
asking
Please, one house now, please. I said Mrs. Joy. I did not ask everybody. Please, let's maintain the decorum class. Mrs. Joy, please, your question.
Okay, so I want to know, is there a difference between shares and stocks? Because when you were explaining the portfolio, you talked about shares and you also talked about stock. So is there a difference between the two of them? Thank you.
Okay, that question, okay. But the thing is, they are different, yeah? Shares actually different from stock. But let me but the thing is they are both financial instruments. They are both financial instruments. But the thing is, stock actually represents how will I explain it? Let me say it like let me say it like this. Shares, it represents like ownership of a company, you know. Like if you have shares in a company, like that means you have like part ownership in the company. But stocks, they can actually still be used in the same way. But you can say stocks. Stock is also part ownership, but it's like in one or in plenty organizations. I don't know if that is making any sense. I'm trying to look for how to explain it better. But shares is simply, they are both part ownership. If you buy shares, you buy stock, you're having you're having ownership in each company. But the difference here is that for shares, it can be for just one company. But stock can be for more than one organization. You can have stock in plenty of, although you can have shares too in plenty of organizations, but stock is more of one or more organizations. They have a lot of differences actually, although they are very similar, but you can say their value, even the scope can be different, because shares has like when you're talking about scope, shares has like a very narrow scope. Shares is not wide the way stock is. Stock is very wide. Everybody can it has a wider scope. Everybody has stocks here and there, but shares has like a narrower scope. I don't know if that makes any sense, but they are both instruments. They are both instruments to generate capital for an organization. It's just little different that separates them. Are you good, ma'am, Mrs. Joy?
Yeah, thank you, sir. Thank
You're
you.
welcome, ma'am. Adebimpe Akinfenwa, I think you raised your hand. Please, 9:31. Okay. Adebimpe Akinfenwa, I think you raised your hand, please.
Yes, I raised my hand. Well, I just wanted to say something that, can we say that when we stock is like buying an item that has to do with
It's like what?
stock. Can we say that is like buying an item, maybe from, for example, and shares is like you want to be part of the shareholders of a particular company.
I really do not understand your definition. I'm not even going to lie.
The way as in, when we say you buy shares, buying shares is like you be maybe one of the shareholders. It depends on the percentage at which you bought, whether you have a percentage holding or not. Then stock, can we say that it's like you are buying part of the maybe company advertise maybe some stock. Okay, you are buying some of the company, you are buying stock from the company for you to get paid later in the future.
I feel like you are still saying the same thing at the end of the day. If you are buying shares to be part of a company, you can buy stocks to also be part of a company. So I think the difference is the sort of organizations that sell them.
It's simple for us to just Google all that, and
If you want to move on, you explain what somebody don't know.
Please,
about. We don't have.
I'm not quarreling you. I'm not
You can't
quarreling
even
you.
correct
You
me.
want to
You
move
can't
on, you
even
explain
about
it.
that. You can't even correct me because I don't
Voice
have time.
is harsh.
If you have your active petty questions, just Google. Let's research. That's the
Please,
essence of
let's move
Google.
on. Please,
For
let's
the
move
sake
on.
of this class,
This
let's move
quarreling
on.
and move on.
For the
Okay,
sake of this
I'm
class,
even
let's
trying to
move on.
move forward, but I actually
Please
cannot
mute
move.
everybody and continue, please.
Stock shares, we can't Google.
Please. I'm the coordinator of this class. I decide when to move on and when not to move on. Immediately she asked me the question, I could have told her I'll Google it, but I wanted to answer her. Please, I don't think you have any right to tell me when to move on or when not to move on, please, or when to tell her to move on. I'm the one that said, okay, I want to give you a few minutes to ask questions. If any question is acceptable in this class, man, I do not really appreciate the fact that you interrupted my class by telling somebody to move on. I really do not appreciate it, man. Please. And I'm the coordinator of this class, and I'm saying it again. You do not have any right to tell anybody to move on. If I wanted to do it, I would have just said,
The one is becoming too much now. Apologies for that. I don't mean to interrupt your class in any way.
Thank you very much, ma'am. So, Mrs. I've forgot. Adebimpe, thank you very much for that question. But if I understand where you're trying to come from, but I feel like you're still saying the same thing. But you can just check back, Google it, and probably just get more explanations on it. This is that clear?
Okay.
Okay, so after all the fight and arguments, let's go to the topic of today. So I think there are no more questions for our last class. So I take it that there's no more question from our last class. So
You should have done
continue now. So like I said, that today we'll be talking about correlation. I mentioned correlation, coefficients. I'm even trying to mute everybody. I don't even know where that's okay. Please, who is my co-host? Let me check my co-host. I have few co-hosts here. Do I have any co-hosts? Please, I need my co-host to be active. So you mute or remove anybody that is disturbing our class, please. I don't have any co-host. Okay, I'm making.
Excuse me,
Just
sir.
make anybody a co-host.
Please, what Olusegun Philip, I think you're my co-host.
Sir, what's wrong with your board? You
Olusegun
can't
Philip.
see.
I know you can't sing.
Okay.
Okay, so please, if you are not talking, please mute yourself. Let's continue with the class. So, sorry, I'm trying to. Olusegun Philip, please, can you hear me? Olusegun Philip.
Maybe it's not on.
Olusegun Philip.
Maybe it's not on. Sir, can you mute everybody from your end?
Make me a co-host if you can.
The moment I disconnected, the thing removed me from a host, so I need him to make me a host back because it's the only co-host available. The moment it disconnected, he removed me from being a host. Olusegun Philip. Jesus.
The guy just connect and
Olusegun Philip, this one just connected and left the class, and he's the only host. Let me call Mr. KABIRU, and I need him to make me a host.
Sorry, I can hear you. What do you say?
Can you please make me a host, please? You are the only co-host available.
I'm trying to. I'm on my way, so let me try and do that. Hold on, please. Sorry, what's your name?
Olanshile Mogbola, sir.
Oh,
No, your lecturers.
I joined. I'm on the road, so.
Mr. KABIRU needs to find out who's even in the class before making somebody here. Okay, while he's doing that, please let's move on so we'll not waste time. Just click on my name. Click on my name. You see an option beside. I think you should see where to make me a co-host. You make me a host. No. So let's continue while he's trying to make me a host. Let's continue, please. So I said that today we'll be talking about correlation. We've been hearing correlation since. So what do we mean by correlation? First, we have three types of correlation. Like I always say, you can judge from what I'm saying when it does.
Sorry, I've done that. You can continue.
Thank you very much. I've seen it. Okay, so I can go ahead and share my screen now. Go ahead and share my screen. Okay, thank you. I think we have started fully now. So like I said, okay, this was where I gave all the meaning to all the formulas I gave. So there are three types of correlation. We have positive correlation, we have negative correlation, and we have zero correlation. So what's this date? 19th, Abi. Today is 19th. Today is 19th of February. So we have positive correlation, negative correlation, and zero correlation. And zero correlation. Those are the three types of correlation we have. So what is positive correlation? We've been talking about portfolio. I said portfolio is when you have two or more securities, two or more investments combined together. So when two or more securities, when they move up and down together, please listen, when they move up and down, I mean, you have shares, you have stocks. So like they go up together, they come down together. That's what I mean by positive correlation. That is what we mean by positive correlation. We have two or more securities that move up and down together. That is positive correlation. And when you have a positive correlation, the correlation coefficient, which we use in our formula that I gave earlier, this correlation coefficient here that I gave in that formula, it is going to be +1. +1 is going to be the correlation coefficient. So that is for positive correlation. So the next one now is negative correlation. So positive correlation, negative correlation is like just the opposite of positive correlation. Here in negative correlation, this one happens where the two or more securities, they move directly inverse, like they move opposites of each other. Like when one is going up, the other is coming down. There's a graph to it, maybe I'll send the graph later. There's a graph to it. So when one security is going up, I'm trying to write it into place. So when one security is going up, the other is what? The other is coming down. They move inversely of each other. So when we have negative correlation here, the correlation coefficient is going to be -1. You know, the other for positive is going to be +1, but for this one, it is going to be -1. So for the last one, which is our zero correlation, this one occurs when there is no relationship between the two securities in the portfolio. There's no relationship at all. Like they are very different. No, they are very different from each other. Why am I echoing? They're actually very different. There's no relationship between the two securities. That is what zero correlation means. Although I don't think I can ask what is types of correlation. That one is just for knowledge sake though. So that is that for that. Next thing we are moving to now is what we call utility theory and indifference curve. I know some of us want to press calculator. Don't worry, we'll press calculator that you get tired. But let's run through the theory. Now, I always say theory is also very, very important. So next thing we are talking about is in utility theory and indifference curve. I'll just you can jot, but I'll just explain what it means. Utility theory, I'm sure if I have economic students in their house, they will know what utility theory means. Utility theory simply it measures the satisfaction that investor derives from different portfolios. I don't want to be writing after, so please be jotting. Utility measures the relative satisfaction that an investor derives from different portfolio. What this is saying is, if you have shares or you have real estate, the satisfaction you derive, your only satisfaction can be your return though, but the satisfaction that you derive, the return that you get from it. Maybe let's say you want to invest in real estate, and you invest 100 million. Then at the end of the day, you are recouping 200 million as a return. That satisfaction, that joy that is coming with it is what we call utility theory. Is what we mean by utility. Now, okay, I'm satisfied with what I invested, and I'm satisfied with the return that I got. So utility has the following. It has like about four or five assumptions. So I'll list them for you now. So the first assumption is that he assumes that investors are risk averse. I mean, they don't like risk. He just assumes that everybody does not like risk, which actually really makes sense. He just assumes that investors are all risk averse. That's number one. Number two, he also assumes that individuals have preference for higher returns to lower returns, which is true. We all want big returns. Individuals have preference for higher returns to lower returns. That's number two. Number three, sorry. He also assumed that individuals rank portfolio in order of their preference. All these things they make sense. Individuals rank portfolio in order of their preference. What it means is you rank portfolio, you rank all the investment, all the securities in your portfolio, how you like them, the one you like the most, the one you prefer according to your preference list. That is when you rank that is how you rank it. And most people, most investors will rank those securities based on the one that is giving them higher return. That is the one you prefer. It's not the one that is giving you higher profit that you prefer. So that is how they rank. That is the assumption. The last one is that investors base decisions solely on expected return and risk. What he's saying is, before you decide whether to invest or not, you would have you base that decision solely on the expected return and the expected risk. Please, is that clear?
Yes, sir.
Just one person. I just need one person to answer me. Is that clear?
Yes, sir.
Very clear.
Sir, can you please repeat the number 4?
I said investors base decisions solely on expected return and risk. I'm trying to write this thing, so I don't want to be wasting time. Okay, so that is that for that. Although there's a formula for utility function. I'll drop it in the group chat later. Out of all my years of checking account pathfinders or icons, I don't think they've ever asked anything on utility. But I would still drop the formula. I will still drop the formula on the group chat. Ms. Adibing, please hold on. I'll still drop the formula later on the group chat. So moving on to indifference curve now. Mr. Adibing, if you have a question, you can write it down later when I'm done. Please just write it down. When I'm done, I'll call you to ask the question. Please, let's move on. Indifference curve. This one is different from utility theory. Please listen very well for this. Indifferent, like the name says, indifference curve is like a graph. This graph now, it shows combinations of securities that give individual investors the same level of utility. Let me come again. I said this is a graph. It shows the combination of securities. That this is indifference curve. It is a graph that shows the combination of securities that give individual investors the same level of utility, that is satisfaction. I already explained what utility is. So what this is simply saying is, this indifference curve now, this is a graph now. It combines all the securities. Let's say you have five security, or you have 4, or you have 3. You will not combine all of them for you. And the ones that give you the same level of satisfaction, let's say for like 2 or 3 of your securities now, like 2 or 3 of your security, you make like you make 10 million naira. They are the highest paying investment that you have in your portfolio, and they are giving you 10 million naira each. So what indifference curve will now do is the three investments that give you those 10 million naira, you will now bring them for you because they give you the same level of utility. You will now combine those securities and combine them. That is what that graph would now show. So the graph would show the ones that give you 10 million naira each, the ones that give you 5 million naira each, the ones that give you 4 million naira each. Like, it will just rank them for you. So that is what indifference curve, that is what that graph does for you. So Mr. Adewumbi, let me take your question real quick before I move on to the next.
I just want to add that when you started with the assumptions, you said there are 5 assumptions, but you actually mentioned 4, sir.
No, there's no stipulated amount. I just give you the ones I know. You can check up on more. I can just give you the ones I know.
Yes, sir.
Okay, so that is that for that. So this thing is not easy. As I'm dictating, I'm trying to write. I want to share this note after for people that will miss the class. But okay, so the next thing we'll look at, but please give me the next thing we'll look at now is please give me 3 minutes. I'll type all this later. But please just be jotting if you can jot. I'll type this one later when I'm done with the class. So the next thing we'll talk about now is capital allocation line. All these things are graphs. I'll most likely send the graph to after, but I don't think I can ask that time, but I will still send it, please. I'll send it. What we'll talk about now is capital allocation line and portfolio selection. Capital allocation line. If you're doing CIS, which is Chartered Institute of Stockbrokers, those are the people that used to ask for all these graphs, all these diagrams very well. So, but thank God this icon we are writing. So, capital allocation line and portfolio selection. That is what I want to explain now. Which we call, you can see it as CAL. In some textbooks, they just write CAL. It's still the same thing. CAL and CML. CML is capital market line. CAL is capital allocation line. They are different. We'll talk about each two of them now. Then we'll move on to solving that I want to solve. So, capital allocation line now. This is, please, let's listen to this too, because all these things they look the same, but you have to like know them. You have to like know how to distinguish them in your head. So what capital allocation line is saying is, it is a line that shows all possible combinations of risk-free assets and risky assets. Let me come again. Capital allocation line. It is a line that shows combination of risk-free assets and risky assets. So what this thing is saying is, this line now will now show you the asset that this one does. It deals with risk the most. What it does for you is, if you have any of this asset that has like 10%, okay, 10% is even small. That has like 70%, that is 70% risky. All those assets will combine them for you and show it on the line, on the graph. Then the ones that are risk-free, that the risk are not too much, let's say they are like 10%, 20% risk, we'll combine all those ones too for you. So that is what that capital allocation line, that is what it does. And you know I said this in our last class that so the graph we have standard deviation. I said in our last class, standard deviation represents risk. I said it to that anywhere for portfolio theory, if you are hearing risk, we denote risk as standard deviation. So that is what capital allocation line is saying. So now we'll talk about capital markets line, CML. Now I said we have
Please,
CAL.
can you explain that again? You're kind of fast though.
Which one should I explain? Capital allocation line.
Capital allocation line.
I said it is a line that shows the combination of risky assets and risk-free assets. Risky assets in such how will I explain? Risky assets in such a way that assets that they are very risky. There are some assets that let me use this as an example. Okay, very perfect example now. Shares and bonds. Shares and bonds. Bonds are very less risky, especially government bonds, very less risky. Some shares too can be, just depends on the company you are buying their shares. Shares can be risky but let's just assume shares is risky. The shares that you are buying, they are risky. So let's say you now buy shares and one other security or one other investment that is risky, then bond and one other one that is not risky. So what capital allocation line is now showing you is, it's going to show you the combinations of all those assets, the ones that are risk-free. It's going to show you like in a line, like in a graph line. I will.
Okay. Hello, sir.
Please, can you hear me?
Yes, I can hear you now.
Okay. So, and it's going to show you another combination of your risk-free assets. So that is what capital allocation line does for you.
Okay, thank you,
That's
sir.
what capital allocation line does for you.
Sir, sorry, please. This one is under which topic? I just joined.
This is portfolio theory, ma.
Okay, thank you, sir.
You're welcome. So, moving on, I said capital allocation line and capital markets line. So, sorry, please. Okay, so capital market line. Okay, please let's listen to this one too. I said capital allocation line. It shows combination of risky assets and risk-free assets. Abi, but capital market line now is now showing what capital market line is now showing. It's showing combination of your risk and your return. The other one was showing, okay, this one is more risky, this one is less risky. This one is now showing, okay, this is the combination of, this is only showing line of risk and return. That, okay, this is your expected return. This is the return for all this your investment or your portfolio. This is the risk for all your investment and all your return, all in the like in the pictorial diagram, like in a graph kind of thing. So it's going to show you that. So anybody that understands this investment, anybody that's into investment banking or investment analysis or all those stockbroking people, immediately they see all this graph. They know what it is. They know what you're saying. They know what your investment is looking like. They know that okay, this is your portfolio. You know this is your particular investment that you have that is less risky. You know the one that you have that okay, this one is not much. So they will be able to advise you. They give you proper advice. Okay, invest more in this one, invest less in this one. This one, so exactly something like that around all of this. So that is what they use to determine all this. So that is what capital market line is saying. Basically, if you check other books, if you check some books, you see a lot of grammar. And anybody that has been in my class from the beginning knows that I always do my explanations in layman explanation. You can go and get your grammar from Google, get your grammar that and package yourself very well from your pack. But I always like that you understand the basic. You know what I'm trying to explain. Some people will just go and cram that thing that is in the pack. You just go and cram it. And the way ICANN has been moving these days, they've been moving wonderfully. That they are trying to, anything that you've crammed, it is not going to work in the exam, or that's what they are trying to do. So I always try to explain the basic in a layman. So what other grammar, when you are reading, you can combine, you can add and join. You can check Google, add and join, cut and join, and go and feel yourself. At least you understand the basic of what I'm saying. If I ask anybody what capital allocation line is, in 1 or 2 lines, you can speak like a chartered accountant and explain to me that, okay, it is a graph or a pictorial line that shows combination of your risky assets and your risk-free assets in your portfolio. If you talk to somebody like that, they know you know what you're saying. So any other grammar that okay, in the graph, it will show that if you have bond shares and they are risky, it shows. So get all of those things. So you'll be able to just buttress your point, but at least you know the basics. So you can check around for other grammar and other English to use and package it very well. So before we solve, because I already gave out all the formula, so we are supposed to. So what we'll do is there are like 2 ways to solve for there are 2 methods, not like 2 methods, but like 2 let me just say 2 ways that we used to solve for portfolio. So we always use this our normal statistics, the one that will do X minus X bar and all those tables. That is there. And another one is CAPM. That was I was asking if they had done CAPM in cost of capital. So we use CAPM, this CAPM method. CAPM, which is your the one that you use for your cost of equity, which is your risk-free plus beta open bracket market premium, or risk-free minus or market return minus risk-free. Someone is saying I'm too fast. Let me calm down. Sorry.
Sir, please don't scare me with this formula you're calling me.
So what they already gave you in cost of capital is CAPM formula. Cost of equity equals risk-free plus beta open bracket market return minus your risk-free. That your market return minus risk-free can be called your market premium. So so that's another way to. So when we get there, we'll deal with that. But before we go into the calculation, let me give you something. Let's just release. It's just theory parts. Nobody's going to say it can come out. Nobody can say this can just be for knowledge sake or for example purpose. But please, let's still write it down. But we're talking about portfolio since. As a chartered accountant, you can get opportunity to manage someone's portfolio. Imagine you get to come and manage Dangote's portfolio now. That's a large that's a crazy work on his own. Because he will have a large portfolio. So in managing portfolio, what are the process? What are the procedures? What are the things you need to know? What are the things you need to do? Which leads us to our next subtopic now. Procedures or processes involved in portfolio management. Procedures or let me leave a line. I'll come and fill all these ones later. So let me come here. So I said procedures or processes involved in portfolio Jesus. in portfolio management. In portfolio management. So the first one is understanding the client's needs. Understanding the client's needs. Before you go and manage somebody's portfolio, you have to know what you even want first. Do you want to maximize profit? Do you want to maximize loss? You don't know what you want to. You might want to maximize loss like that. So you need to understand. Understand the client's needs. So what this is simply saying is understand the client's needs. Individual, they have variety of needs. Investors have variety of needs. So as a portfolio manager, you need to understand the objective. You need to understand the reason, the purpose of his investment. So you need to know that. So the second one now is preparation of an investment policy statement. Preparation of an investment policy statement, understanding the client's needs. Preparation of an investment. We must solve today. At least we must solve like 2 questions, whether we like it or not. The people said we have not been holding SFM class very well. Now we'll use class to choke people. I said I will explain them. Let me just list them first. So security analysis. Jesus, I've done up security analysis. The 5th one now is your portfolio construction. Your portfolio construction. Number 6 now is portfolio management. Portfolio management. The last one now is performance PM. Performance measurement. And report them. So these are the 7 procedures you need to do as a portfolio manager. So I already explained the first one, which is understanding your client's need. The second one now is preparation of an investment policy statement. In creating an investment policy statement, it is suitable, like it is needed for a client. How would I explain? I'm trying to explain something. But let me first explain investment policy statement so we even know what we are even talking about. Says investment policy statement. This is like it is a written document that expressly specifies the objectives. After the objectives, you will now also specify the constraints of individual investor. This constraint and the constraint and the objective, it must be strictly followed. That is why it's like an agreement. Let me say it's an agreement. It's a written document that will tell you that, okay, this is my portfolio. This is what you should do. This is what you should not do. Do it like this. Don't do it like. So you guys need to create that IPS, that investment IPS. We call it IPS. That investment policy statement. You need to create it. You need to prepare it so you will know. What you should do and what you should not do. So the third one is asset allocation. What this is, after you've created this IPS, you will now have to allocate.
Sorry, sir. Excuse me, sir.
Please let me finish.
This IPS, is it created by the chartered accountant or the clients?
Okay, I will explain to you, but before I explain, please, next time, either you raise your hand or just allow me finish. Like it breaks the flow of my explanation. You know, I'm freestyling. So immediately you ask that question, it breaks the flow. So please.
Yeah, I'm sorry.
No problem. Like you said, the IPS is not like it is created by one person. The owner of the portfolio will make a statement. He will write that this is what I want, this is what I don't know. But the accountant, which is the investment manager, he will review it. That okay, can I do this? If I do this, hope it's not tamper with my ethical. We all know ethics now. Our ethics are normal 5. Is it 5 or before? Our ethical. Hope we will not tamper with it. So you need to review it, and all those, even the IPS, it can be changed when necessary. Sometimes conditions or some certain things want you to change the IPS. So it can be changed, it can be reviewed periodically, but will be created by the owner of the portfolio, but the accountant or the investment manager will review it. Thank you very
Okay,
much.
thank you,
So I was
sir.
explaining, no problem. I was explaining asset allocation. I said what asset allocation is doing is, okay, let's say the person that wants to create this portfolio now, he's telling you that, okay, I want to invest in this, I want to invest in this, I want to invest in this, I want to invest in that. He has not given you like it's just telling you that, okay, which one do you think I should invest in? Because that's why you're a portfolio manager. So what you now do is you use the finance available. You use to allocate, you allocate the finance available among different classes of assets in order to optimize the investment, the mix of investment to increase return. You check that, okay, you have how much, you want to buy this amount of shares. How much can I invest here that will optimize the mix, that will make the mix, that will make it balanced, that will not make this one, this one that has higher return, that will not make it small. The one that will not have lower return will not be much. So you have to check that finance available. You allocate them to the assets, to the investments. You share them among each and every one of them. Let me be correcting my English. So that is for asset allocation. The next one is security analysis. So after asset allocation, after you've allocated that, okay, you buy this one, there is now need to analyze the individual securities in the portfolio for like possible investment. Let's say, okay, you have said, okay, buy this one. You will now go and analyze the individual securities, each one of them, that, okay, let's say you buy shares now. At what period of shares you used to go up? What period you used to come down? There are some shares that during rainy season they will go up, during dry season they will come down. There are some shares that if Elon Musk should say something today, the shares will fall. There are some shares that news affects. There are some shares that the way the president should say something will affect them. So all those things are what you should now go and analyze. Being a portfolio manager, you now go and analyze them. That is what security analysis is. Now for portfolio construction now, this one represents when you are doing asset allocation, you already know the one you want to buy. You already know, okay, this is. So the process of now determining and now selecting the mix of security among various assets, that is what we mean by portfolio construction. Asset allocation, you are allocating it. That, okay, buy this one. But that purpose of now of determining, of selecting, of gathering them is what we now mean by portfolio construction. Because now you are trying to maximize the benefits of diversification. That's what portfolio construction is just doing. To maximize, I already explained diversification. You are maximizing the benefits. Like you are saying, okay, we are buying 10,000 shares. You are buying real estate. You are buying this. So you are trying to just optimize the whole investment. So that is what portfolio construction is. So now portfolio monitoring. Normally, our portfolio needs to be monitored and reviewed regularly after it has been constructed. So you'll be able to account for changes in prices and other factors that are associated. You need to be checking, know that, okay, this price has gone up. What happened? Why did this go up? Why did the price of these shares go up? Why did the price of these shares come down? Why is the bond? Why is it taking time? Why is a lot of things? So you need to monitor and know the things that affect, the factors that affect your investment or your portfolio. That's the work of a portfolio manager. So if you are seeing any job offering that they are telling you, okay, we need a portfolio manager, don't just go and think you just be saying you have a lot of things, because when he wants to make investments, he will come and meet you, okay, where do you think I should invest? So it's now your job to, and the thing is, accountants, we are suffering because most people just come and think that accountants are gods. You feel like you know it. If you're not chartered plus again, very terrible in organizations. They just come and ask you anything, because they feel like you should know it, that you should be able to breathe. You should be, you're a chartered accountant now. They will just come and, you have chartered accountant now. You have chartered accountant. You know it or you don't know it, or they will come and meet you. So some of all these things are things that we need to also we need to also know. So the last one is performance measurement. After you have monitored your performance, after you have monitored your portfolio, you also need to also evaluate the performance and review to ensure that you are meeting with the IPS, the IPS that you signed. That, okay, let's say the IPS that you signed that I'll be this, if you invest in this one, we give you 30% return. So you need to be evaluating and be reviewing it. Am I in line? Am I in line with the client's objectives? Am I on this? Are we not making loss? So you need to be measuring the performance of each of your portfolio. I need to be reporting back to the owner of the portfolio. That concludes portfolio theory. Thank you very much. We'll see you next week, Monday. We are done with portfolio theory.
Wow, thank you, sir.
You are very eager to go. You are not ready. That will solve questions. That will solve questions now. You want to run? I'm not going anywhere. So let's solve. So what I will do now is I will be dictating the questions, and for the ones that are not, the ones that I will start with, they are not, we'll start with the way we used to do now. We'll first play. Pope, you know now. We'll first play with small questions first. Before we now go to the the real ones. I will use this small question. Is Pope in my class? Pope has run away. You will not come and be disturbing with questions later.
I'm with you, sir. I didn't run away. I'm with you.
Don't run away, Pope.
Mr. Jerry called you.
I'm with you. So we are solving.
Yeah, you called.
I thought you were not here.
No, I'm with you. I'm following, but it's just that explanation. I'm waiting for the calculation.
Oh, no, voila. So we are there now. We are there. So question 1. This is our first example for today. So Super Eagles Limited, you can write. I will be writing it here too. I know some people say I should snap it, but please let's write this particular one. This one is not. Some of you just want pictures. We still have time now. We have about 1 hour, so we can still. So Super Eagles Limited, please. Super Eagles Limited is considering investment. Super Eagles Limited is considering. Please, I explained this in our last class that some people will be saying, why don't I used to come with notes like other lecturers used to do? Please, this is my first time of teaching in Apex, so I'd not combine notes. So all those lecturers already have known that they use from last 3 diets, so it's very easy for them. But people like us like this, we don't have to be managing my methods like this. For now, by the grace of God, I will not see you next diet. So the next people that are coming they will benefit from the notes and all of them. So
Amen. Oh, amen. We will not see you next time.
Even I don't want to see you. Think I want to see you. So please,
I want to see you as a chartered accountant too.
What did you say, sir?
I said I would like to see you when I'm chartered.
I would like to see
Oh,
you.
yeah.
I would like to see you too. Okay. So come in, let me see if I can many table 3, 1, 2, 3, 4, 5, 6, 7. This is 7. 1, 2, 3, 4, 5, 6, 7. 7. We think this will work. Okay. So the first thing we have here now, we have security. Daniel, I'm with you. Please, anything you want to tell me, don't tell me to snap the picture. Don't tell me to snap the question. I'm with you, Daniel.
Okay, sir. Sir, I'm not saying you should snap the picture. What I wanted to ask whether the examples you are giving us is from the Pathfinder.
Okay, no, what I always do is, I don't know if you are just joining. What I always do, I always bring questions from books and packs, not like I can pack, but other what's the name? Other professional body. I'll bring the question like 2 or 3 will solve in class. Then when we are done, when we are doing our, because I always take like half a class for revision, then I'll now bring like 1 or 2 questions from Pathfinder, then we'll now solve it together.
Okay, all right. All right, no problem, sir. Thank you.
You are very welcome, sir. Please, I'm typing. You that you're writing. You're supposed to be faster than me. So immediately I'm done. I'm moving on to solution state. I'm moving on to dictation of the requirements. So please, write. I've made mistake with this table. Jesus. Okay, let me just extend it here. Add another table for me now. Yeah. Let me continue. Just let me do like this. Okay, this will work. I cannot be adding to this table, please. It's still the same thing I'm trying to write, so I'm just changing some things. Please, if you're writing, you're supposed to be faster than me, even though you have to wait for me. 0.3, 0.4, 0.3, 0.2, 0.6. This is how your question will look like. But the thing is, with this portfolio theory, don't really like this. They don't really like this method. They prefer CPM. Let me tell you something about SFM. About SFM questions. The way I can set their questions, they can set the easy ones, but they always set the ones that link you up, that links you to another topic. Because they're just using one stone to kill two birds. That is why number one is always business valuation. Because in business valuation, they will test a lot of things. They will test cost of capital. They will test investment appraisal. If it's APVO, if it's MPVO, anyone they want to test, they will test everything in one question. So it gives them opportunity now to test other things in other. Imagine they test only one topic in question one. SFM is so they always try to. So they always try to set the ones that can lead them to other topics. So please, you need to solve pathfinders. Solve pathfinder. So required, please. Number one.
Sir, please can you scroll it up a little bit?
That's why I said you should be faster than me. Because I have to continue now. No, when I'm done, I'll come up. Just scan it, please. Okay. So required, number one requirement. Calculate the expected return. Calculate the expected return. Calculate the expected return for each security. Separately. And for a possible okay, sorry, for a portfolio, comprising 60% of X. This is actually a very good portfolio question. This is not even a warm-up question. This is diving straight into it. I thought it was like a warm-up question. Assuming somebody, let me just you guys. Somebody came to somebody sent me a question. Somebody sends me a question to solve for her. The person is from Apex too. I don't know, it's women that send me questions. Men, are we reading like this? Please let us read. So she sends me a question. And okay, I don't know where you guys had gotten to in business valuation, in cost of capital, but the question was about cost of capital. So what happened in the question was did not give cost of debt. Did not give cost of debt in the question. And she wanted to use but she wanted to do cost of capital. And she will need cost of debt to do a normal formula. That's how this woman, she first sent me a text message I think it was in the morning first. He sent me a text message in the morning. Me, I looked at it. I'm like, first thing that came to my head was like, I'm not even your cost of capital lecturer. Why are you sending the question to me? But because I'm a very good person, I told the woman that, Ma, please, I just woke up. Please let me attend to this later. That's how I forgot though. As I forgot like this. Can you believe that in the afternoon, I did not enjoy my life? This woman was just calling me. Now I even got to one point. She sent me voice note. She was like, she did not know why she's doing this thing. Or that what is this? She has looked for cost of capital, look for cost of capital in the question. There is nowhere the cost of capital will be from. That she has tried every possible thing. I say, Madam, relax. So I should not tell her to relax. So I say, I'm the cause of the problem. I say, Ma, I say I should not tell her to relax. So that where would they get cost of capital from? That she has tried everything she knows, no cost of capital. I say, yeah, Ma, please, I'm in transit. Let me get home. I will check it. He said, she better get home and call her back. I said, Ma, it's no fight now. So I said, okay. So on getting home, I looked at the question and saw that ideally there's nowhere there's nowhere the cost of capital would come from. So if you do not understand some things in SFM, that's what I always try to explain basically. If you don't understand some things in SFM, you would not get the question. Basically, what they did, where they got the cost of debt, where they got the cost of debt from, it was from an assumption. I don't know if you know, but if you do not know, note today that if you are doing your cost of capital and they do not give you cost of debt, you just assume you're risk-free because they will tell you to use CAPM or something. So use your risk-free, that percentage of your risk-free. That is what you use as cost of debt. When I told this woman, see problem, like I caused another problem. But like, why would they do something like this? Why would they assume? See, ma, I'm not the one. I'm actually not the one. That is what SFM is like. See, ma, I'm not the cause of all these things. I did not do all these things. They said, then they should have written it then. I say, ma, they did not write it, but just note today that if they do not give you your cost of debt, you assume you're risk-free. Say, thank you very much. Say this one down. So where I said that is some of you learn Pathfinder. You cram Pathfinder. It's good. It's very good too, but please know what you're cramming. Know it, learn it. It's better. I know who I'm talking to. I'm talking to somebody particularly, but no problem.
No problem.
So please, that's the end of my story. So please let's read. That's just the point. I'm just using all these ones to type. But I'm done with the questions. I'm done. To type my question. Please, and please don't expect me to wait when I'm done. I'm typing. Usually you're writing, you should be done. In the portfolio as a okay. So this is actually a very good portfolio question, honestly. Very good. You can see a question like this in your exam. You honestly can. I'm not even lying. It's a very good question. It's a very, very good question. Okay. So we should get to work, Abi. We should start. So someone told me to scroll up. So let me scroll up for the person for 1 minute. Just 1 minute. So let me just read the question. So they said the question says Super Eagles Limited is considering investment in one or both of two securities X and Y, and you are given the following information. What this is saying, he wants to know if you should invest in X or you should invest in Y. So this is your securities S. This is your possible rate of return. This is your probability of occurrence. This probability of occurrence. I don't know if anybody has. Please be looking at that formula I give you. There's a place where I wrote P. That P stands for probability X. I gave it in the meaning. So this is the probability that was given to you. That was given to you there. So this is the probability and a figure in the table that's written there. So my requirement 1 says calculate the expected return for each security separately and for a portfolio comprising 60% of X and 40% of Y. I didn't write that. And 40% of Y. Assuming positive correlation, I already explained positive correlation. I said positive correlation, it means that they are going if the two securities are going up and down at the same time, and it's going to be +1. I explained it though. Nobody should not explain it. So but please don't mix it up, Sha, but that is just the theory part. So between the possible rate of return from the shares comprising the portfolio, that's number one. Number two is saying calculate the expected risk. Calculate the expected risk of each security separately and of the portfolio as defined above. Then the third one is the theory part, the objective of portfolio diversification, why the risk may differ from. I already explained all of all this earlier. So please give me my answer in the next 5 minutes. Somebody, anybody. My answer. Can anybody give me my answer? So nobody can. So I should solve it. People are not answering me. Should I solve it or you solve it?
Yes.
You will
I'll
solve
solve
it.
it.
Please solve it, sir.
Hope now there they see you. So the first one is determination of expected. Say we should calculate expected return, Abi. So determination of expected return. I will not do it. I will not do it. I will not do it each. I'll do everything together. Then I'll explain it to you. Don't worry, you understand. Don't worry. Don't worry. So and standard deviation. When I say standard deviation, someone should tell me what does standard deviation denote?
Risk.
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 Thank you. Thank you very much. So we are trying to calculate the expected return and the risk for securities. For securities, X and Y, Abi. Please follow me on. So this is the first thing we are doing. So let's do it one by one. So let's come here. Let's do for security S first. So let's do for our security X. Let's do for our security X first. If I can want to release to you, they always test portfolio. So please learn it. So let's do for security because they said we should calculate for each securities. So let's do for security S first. So here now we'll need table. We'll need table. So I think I will have probability return, expected return of X minus X bar. I think I have about 6 or 7 tables. So let's do this table. So I should have 2, 3, 4, 5, 6, 7. So I would just do like this. I'll be increasing them one by one if I need any extra. So the first thing that will come here now is our probability. Let me off my boldness. So the first thing we have is our probability. Probability. So we have probability first. So let's come here. Let's come here and do this. So the first, so someone should give me what's the first probability of for
0.3.
Well, okay, but okay, before we move on, let me still do this like this so it will be easier in future. So P here now. Sorry. So I said what's our first probability?
0.3.
0.3. That is underlined on like this. So 0.3. What's the second one? Okay, let me first dash
0.4.
3. Sorry. Okay, so that's how I have 3 first. 0.3, 0.4. What's the third one?
0.3.
0.32. 0.3. Okay, let me have an extra table for total. We have an extra table for total. So please, what's the total of all of them?
1.
1.00. So let me bold in this and underline it. Okay. So after we have our probability, the next thing we have now is we have our return. We have our return, which they gave us. We already have our possible rate of return. So that is what we have now. Abi is not in the question.
Yes.
Yes, sir. It is.
Please follow me, I beg. So return, which can be denoted. No, when we solve one, you will know better. So return now serves as our x, like return of x. So return of x. So let me just put return here since I already opened another another space for, so I can just come here and say, tired of this my bold and x, so Control V, Control U. So I can just come here and say x, Abby. So what's my first? So hey, who is cooking there, please? Messi, please, I'm coming, Messi. So what's my first return?
30%.
30. 30, Abby.
Yeah.
30. What's my second?
25.
25. You just rest. 25. What's the third one?
20.
20.
So what's the total? So
25.
Okay, so this is the total of this now is our return. Abi is our return. So what is, let me write it there now. So this is 25. So this is 25. This is our return. So the next thing we'll calculate now is our expected return. You have a return of 30.
25.
Sorry. What did you call it? 75?
5.
Like this?
Yes, sir.
Yes.
Okay.
Yes.
So,
5.
like I said, you have probability of doing something. Let's say you want to make a return. Your expected return, that is the return you want to make. You want to make a return of 30. Okay, your actual return that you want, it is 30. You want to make 30, you want to make 25, you want to make 20. And there's a probability of making, if you want to make 30, probability is 0.3%. If you want to make 25, probability of is 0.4. If you want to make 20, probability is 0.3. So what is now going to be your expected return? Anybody?
You multiply
together. 40 minus 75.
Probability times return.
Thank you very much. Thank you. I like my students. People know book. Messi, please, I'm coming. I'm with you. I just want to go far a little bit before So our expected return now, we are going to represent it with, we have always been representing them with something. So this one will represent it with X bar. Where do I get that bar from now? Hold on, please. Let me get my X bar. So it will differentiate. So it will differentiate what we have here. So let me do symbol. Bar here. I don't know. I'm trying to get by, but I can get X. So just put it there. I think it is here somewhere around there. Okay, no. People that like word, maybe we should know where. Okay, I think it should be here. Okay, I found it. Okay, so I can have this. I can have this here. So X bar. Okay. So what did you call my first one?
9.
9. Control B and Control U, leave me alone. I'm 9. What's the second one?
10.
10, yeah? What's the third one?
6.
6. God of blessing. 6. So this is my expected return. This is my X minus X bar. This is my X bar. This is my expected return. So now, what is the total of this?
25.
25, Abi. Like this. So what will now be my X? So this total, this thing that we have here, let me move this a little bit here. So here now we have our X. But I need bar again. That's why I don't like to take this course online. It's just So let me go back to my equation, my ascent. So I need my bar again. So so this is my x bar. My x bar now. This x bar. My x bar equals 25, Abi. So my x bar equals 25. So the next thing that we'll now do now is according to our formula. We are acting according to, we are not picking all these things from our head. We are just acting according to our formula. Our formula is px minus x bar squared. We already have b, we already have x, we already have x bar. The next thing to do is to get our x minus x bar. It is just what the formula says that we are trying to get. Please, it's not like we are just picking. I'm not picking at random. I'm just trying to do according to the formula. So the next thing I have now is x minus x bar b. X minus x bar, my bar again. I'm going to look for my bar. X minus x bar. Where did I get it? I can look. That's for me. So x minus x bar. So what's my x minus x bar here? I know this is where people will fuck up. So why you tell me my x minus x bar?
21.
What's my first one?
21.
15 and 14.
What did you say?
30
21,
minus
15, and 14.
15 and 14.
You are wrong, man.
The first one is 5.
The first one is 5.
The first one is 5.
First one is 5.
The second one is 0.
0.
Second one is 0. Thank you.
Minus 5.
Minus 5.
Minus 5. So I'll explain to people that did not get it. So what happened was that's why I kept it here that this is our x bar. So this is our x bar, not this one that is here. These ones are just this is our x bar 25. So you subtract your x from your x bar, which is 30 minus 25, 25 minus 25, 20 minus.
Okay.
Yes.
Okay. Oh, so from the total of the x bar.
Yes, ma.
Okay.
She said, "Oh, sorry, ma." That's how we do. We don't move slow. So the next thing now is what now?
x minus
x bar squared.
X minus x bar squared. But even not the way my square used to stress me. Let me see if my equation here says as squared. This we got this.
So please, how did you get this x minus x bar again?
Yeah, our total of our x bar is 25. So our x is 30. 30 minus 25. 25 minus 25. 20 minus 25. You still don't get it, do you?
It's clear as day.
I'm trying to see if I can get square, so it will be a little bit better.
You can get the square on the home tab too. Okay.
Can I ask a question?
You can. All I did.
So I've been raising my hand since.
Sorry.
Okay.
Are you sure we not manage this thing like this?
So you can type to use the subscribe.
You can manage it.
I'm trying to even delete it. Okay, so let me do it the way I always do it. So x minus x. No,
you can type to and use the x bar on the font what you call ribbon. X raised to power 2. You can type 2, highlight it, and use the x raised to power 2 under the font section.
Oh. Okay, I will do that later, please. So what's my figure for this? But at least you guys understand what this means now.
Yes, sir.
The first is 25.
25, Abby?
Yes, sir.
25. Second one is
0.
0. The third one
Minus
is
25.
minus what?
25.
Did you say minus 25, ma?
Oh, 25, sir.
Okay. So the next one now is what?
The
Next one now is what now? You have been giving me since the reach now. You don't
bracket x minus x bar also.
Thank you. P minus x minus x bar. So P x minus x squared. Abi. Person that gave me that option of font and ribbon, I'm coming out. Come and do that when I'm done. Finally. The problem will be start from. Sorry. I have to manipulate. So what's my first one?
7 point.
Please, is there anybody that does not understand where we are getting all these figures? And I think Messi, you raised your hand. Don't hope it's not about the figures. Is there anyone here that does not understand where we are getting these figures?
No, I don't have problem with the figures. Thank you.
What do you have problem with, ma'am?
Okay, you asked earlier that what is standard deviation, and everybody equals like also risk. So I don't know how you got that.
Oh, I already explained it previously that for what is the name? For portfolio theory, we denote risk. I mean, we denote standard deviation with risk. So I asked that was standard deviation. They said it denotes risk. Yes,
Okay.
ma'am. Yes,
Thank
ma'am.
you.
You're welcome. So my what's my first one?
7.5.
I'm asking. I hope there's anybody that does not understand. Is there
Okay,
anybody
so
that
I
does
don't
not understand where I
understand
get
that x minus x bar, please, sir.
7.5.
30 minus 9. But it's
Hold on,
not
ma'am. I'm coming. I'll explain again. 7.5. What's my second one?
0.
0.
Zero.
What's the last one?
7.5. 7.5.
7.5.
7.5.
So what was the truth? Jesus. Yeah.
15.
Holy Ghost fire.
That's 15.
People should hold on. My battery is low. Let me go and try to see if I can charge. Yeah, my phone is outside. Please hold on. Just give me 5 minutes. Let me see if I can plug my system in. Please, just 5 minutes, please. 4 minutes more. Yeah, sorry for the break in transmission. I think I had to charge my battery. Was low already. And there's no light in Nigeria like this. It's everybody that's suffering. So like we're solving. So okay, before I move on, I said what's the total of this?
15.
10, Abi? 15. So before I explain, Mr. Danny, I'm coming. So the woman that said she does not understand. So let me explain everything again.
X minus X bar.
Please let me just explain everything again from beginning.
Okay.
Our formula says square root of P open bracket X minus X bar squared. That's our formula to get that's to get standard, what's the name? Get standard deviation. And I said I'll be doing the two together. That is why I'll be doing expected return and standard deviation together. Does anybody know that even everything that we've done expected return already, which is our X bar. This is what we've done already. This ER, that individual that we got was our expected return individual. So in getting our standard deviation, we needed to do P open bracket X minus X bar square. So that X bar, what we did was we multiplied this our probability times our return. So we got expected return. We got expected return 1, expected return for security X2, expected return. So addition of all the expected return. We are just trying to multiply by the probability now. Okay, of getting 30, your probability is 0.3. Of getting 25, your probability is 0.4. Of getting 20, your probability is 0.3. So individual of all those return, the addition. So the expected return that the person is expecting from this question is 25. So that is your X bar. You just now get your X minus X bar now. We will not do individual again because you already added everything together. It's the addition you will use. So you now do 30 minus 25, you get 5. 25 minus 25, you get 0. 20 minus 25, now you get minus 5. So after you
Hello,
get,
please stop all these your side comments. It's distracting, please.
please, when you now get your X minus X bar, you now multiply it. So you get your X minus X bar squared. Then
I know these ones.
you will now multiply it by
by
the probability again.
Thank
you very much. You're welcome.
Thank you.
So like I said, while solving this question, this question said we should calculate expected return and standard deviation. So we already calculated our expected return. I gave the formula of expected return at expected return equals X bar. To get your X bar is your probability multiplied by your return. So our X bar here now is our expected return. Let me type it here. I know people will still ask me. So let me see. Expected return equals 25. Do we all agree for X? We all agree first. I mean, there's any counter opinion?
Yeah, we agree, sir.
So this is our expected return for security S as 25. So to get our standard deviation, I'll be denoting standard deviation as SD now, is equal to okay. So let me come and find my formula again. So I gave the formula. Someone should put all those things in the formula and give me my answer.
That is
this. So I said it is P
open brackets X minus X bar squared.
I'll look for my X bar again.
Which is too small.
X bar.
Square root of 15.
Minus X bar. Okay. So minus X bar. Minus X bar squared, Abby?
Yes, sir.
This my bar is too long. I'll have to cancel everything. But please, this P, I gave the formula and I snapped it and sent it to the group, please. P open bracket X minus X bar squared. So please let's fix those figures into them. So we are supposed to have our P X minus X bar is what? Somebody.
15.
15. Thank you very much. So that means we have our standard deviation now equals 15.
15.
Which is so we have square root of 15. So which is what?
3.873.
3.873.
873.
So that is our standard deviation for security X. So let's do security Y. I'll be doing it too, but everybody let's try it. Classwork, security Y, I'll be doing it here too. You know the way we used to do it now. So be doing your own, I'll be doing my own. So we see who is correct. Maybe it's you or it's me. The security Y.
So I need the figures for security Y.
You need what?
The figures under security Y in the question that you give.
I gave them now. I said 50, 30, 10.
Stop for a minute, please.
Didn't get it well. We didn't get it.
I said the possible rate of return for security Y is 50, 30, 10. And the probability of occurrence is 0.2, 0. I wrote it now, Abi. It's here now, madam.
You take decision better, so that at least you're in control and you know that yes, you are getting.
So, madam, this is it. This is 50, 30, 10, 0.2, 0.6, 0.2. So that is what it is for Y. So I've moved the wheel. So please, let's also for security Y, give me my answer. Somebody should have given my answer now. Just for security S together. Hope there is no question.
How did you calculate root of 15 to get the 3.873?
Where did we what, ma'am?
The 15, the square root of 15. If you just type it on the calculator, it doesn't give me 3.873. I don't know what else you guys pressed.
What does it give you?
Just gives me back my square root of 15.
I was going to give you back your square root of 15.
Are you using natural
Press
display?
SD on your calculator.
Price is equal to.
Oh, okay. I should press SD.
No, it's equal to.
No, the equals to is giving me equals to square root of 15. It didn't
Press
change it.
SD. Press SD.
All right. Thanks. I've gotten it. Thanks, dear. I appreciate it.
Go to me, please. I'm listening to you.
Good evening, sir.
Good evening, sir.
Well done, sir. Please, sir, can you please roll up to the first question that we are addressing?
Like this?
Yes, the question that we are addressing, we are answering there, the first one.
The question.
Yes, sir.
Please solve for security. Why I'm not solving it. That's why I can be scrolling like this. I just need my answer.
Hello, sir.
I'm with you, sir. I'm with you. And this is it now.
Okay.
Abi?
No, the question, that's the requirement.
Sorry, like this.
Okay.
12.65.
Okay, yeah. I just want to be sure of the, we said standard deviation is a risk. Fine.
Yes.
What about variance too?
Variance. You don't need to do variance. The thing is, you can do variance, but you do variance. All these things, some of them is variance now. This formula for variance is you will do before you do standard deviation. You know, standard deviation is the square. Is it square? Is square root of variance, Abi?
Yeah, I think there is a step further to that after standard deviation.
Yeah, exactly. So that point that we had P open bracket
Yes,
X
that is the variance, sir.
That is the variance. So the moment is do the square root is the standard deviation.
So okay, sir. My concern is that is a risk as well, right? So
what
how
is
do we know
variance?
Yes, the variance is a risk too, right?
I did not mention that though, sir.
Okay.
The standard deviation, we just use it to denote risk because that is how we calculate risk in portfolio.
Okay.
It's the standard deviation and stick to standard deviation, SD or standard deviation formula. Leave variance, no leave variance at all.
Okay. All right, sir. Thank you, sir.
You're very welcome, sir. So please, what's my answer, anybody?
12.649.
12.65.
65.
Hope, are you don't giving me an answer?
12.65.
Please, I need another. I need another answer apart from Pope.
12.65.
12.65. I think that I don't need to solve it now. Do I? Anybody? Do I need to solve it?
No, sir.
Don't bother.
So this one is clear.
My own answer.
Your own answer is
La
what?
Liga.
Your answer is
Liga.
Canada.
La Liga. La Liga.
La Liga.
No, APL ni.
So the answer is 12.6. 12.649, approximately 12.65. So that means I can continue. That means we have solved number one. That's for
Yes.
individual. Please, that
Yes,
means I
sir.
can continue. I have 78 students in this class. I'm continuing. Oh. So now, nobody should bring me back. Oh. I'm very scared that somebody will bring me back.
Sir, please, I don't know how you got this 15. I've been trying to use my
Knew it.
calculator. I can't get it.
You can't get what?
This 15 standard deviation, I've been trying to use my calculator. Just like
Why
the
don't
way
they,
you do.
why don't they told to press SD?
I'm not the one.
No, she's not the one.
Please press SD. When you put the square root of 15, press SD. There's SD. God of mercy.
I don't
Where's
know
my
how to get it.
7.5 plus 7.5.
Is that what you mean?
You have to go for the calculator there.
Please. 1 hour, please. This
Yes,
is
please.
a portfolio. I don't have access to your calculator. I don't know how you are supposed to press it, but I don't think you should be having calculator problem. See, but this is how we got 15. 7.5 plus 7.5, we got 15. So 15, you press square root 15. Then you press answer. If you don't have answer, you have equal to. If you don't have, if your equal to is still giving you square root 15, press SD. It will give you this 3.873. If you have somebody around you, just tell the person to show you. But I don't have access to it. I cannot see it. So I don't know where to come in. Just press SD, press equal to, press anything that would give you. Must I give you this answer? Don't be like, don't get La Liga. I must give you 3.873. But if you still do not get it, like I always do and I always say, come to my DM. Let's talk about that on DM privately. Don't let us waste time of our class. Thank you very much, Ma. You can
Please just write the security Y. The answer out without
okay. That's
so that
good.
we can go back to it in case we didn't get
So
it.
security Y, our X minus X bar now, our expected return. Our expected return. Our expected return is what?
30.
Is 30. And our standard deviation, which is our risk, is what? 12.65, Abi?
Good morning, tomorrow. Go to the school now.
12.65, like this, Abi?
Yes, sir.
Thank you.
Yes, sir.
So now let's go and calculate let's calculate return and risk for the whole portfolio. So calculate return and risk of the portfolio. You people know this portfolio formula is very long. So you people know the formula. You will just be giving me figures.
Yeah.
Yes, now if you're not in our last class, please check the group chat. I dropped the formula there. The formula is very long. If I start writing it now, I would most likely want to use time.
So that's 60% of X. When are they going to use it?
We are there now. Are we not? Why are you rushing, ma? Don't rush. So our return of our portfolio return, the formula I gave is I said, please. I said weight of X. Let me mute everybody. I don't like when my class is interrupted like this. So okay, can continue now. So I said my formula is weight of X multiplied by the expected by the expected return of X plus the weight of weight of Y multiplied by the expected return of Y, which is Y bar. If that's if we are doing for Y, weight of X RX bar plus weight of Y RY bar. That is for the portfolio return. Let me write this one. This one is not that much. Is that risk one that is much? So for people that were not in our last class, I said this is the formula to get this. So your R X bar, yeah? It's almost 11 o'clock, but we are here. We must finish, at least we must go far today. So X bar, okay, sorry. So plus Abi plus the weight of Y and our like this Y bar again. So let's go and do my Y bar. Like this Y bar. So this is the formula to get our return of portfolio. Formula to get our return of portfolio. So now let's fix in our figures. So we said the weight, they already told you that. So what's the weight of X? They already told you that you assume that for a portfolio comprising of 60% of X, 60% of X and 40% of Y, that is your weight. That is your weight. So we say 0.60 Abi and multiplied by what's our okay, let me allow you guys to talk now. So I need figures. So you can talk now, Abi. Hello? Can anybody? Can you hear me?
Yes.
Yeah, with you.
So what's my expected return for X?
25.
25. Jesus.
3.87.
3.373.
No, now that's our risk. What are you calling for me?
Sir, just scroll.
25 then.
25.
I told you 25.
I cannot be scrolling up and scrolling down now. How about you? You should pity me.
25, man, not 35.
I got 25.
Okay.
So the weight of Y is 0.40, Abi.
0.4.
Same thing. What's my weight? What's my standard deviation for Y?
30.
My expected return for Y.
30.
30. So what's my sorry. So this one is equals to what?
15.
15. 15.
The other one is equal to what?
12.
Plus 12.
227.
12.
So what's my total?
27.
27. So that is my that's my portfolio return. So this is of combining security X and security Y. This is the return that you are going to get. So now let's calculate portfolio risk. I think we'll be able to solve only one question today, Sha, anyways. But we tried. At least we've gone somewhere. So let's do portfolio risk. Like I always say, portfolio risk stands for standard deviation. So let me write calculate. Okay, I already repeated it at the top now. But let me just explain it here. Let me just say sorry. Let me just because I know my students, people come and be asking me plenty questions. So portfolio, let me just say portfolio return like this. I'm supposed to do portfolio in 1 or 2 classes. This is our 3rd class. Although that last class was cut short, sharp. Tax people took our time. Portfolio now. Portfolio risk. So like this one that I said the formula is long, so I'll not be able to write it. So please, I'll just need my figures. I'll just need my figures. Standard deviation of portfolio. So I need my square root, Abi. So I think I will need the person that was giving me advice on how to do my square. Please teach me, please. I'm always willing to learn. Who is that person? Somebody was telling me that time.
Malam.
Person has gone.
No,
I don't think he's here.
Please, you were telling me something on how to do my square the other time, please.
Yeah.
Hold on, please. When I get there, just put me through. So the first one is our weight of x squared. Abi? Please look at the formula, which is 0. So that is now 0.60. So why are you still doing this? 0.60. The person giving me an idea for my square. What did you say?
Okay, so you type in 2 now.
Like this?
Yeah, highlight it.
I think it is highlighted.
Yeah, because you are in the within this what you call that you selected, the formula that you selected, it won't work. So you need to take out that 2. You need to take out the 2 first.
Like this?
Yes, then you click outside.
Now you're gone. I can't hear you. Yes, sir.
So, no, not there, not there, sir. Go to under your phone, inside your phone ribbon. Click on the X bar, the superscript.
Inside my what?
Where you have the board, italic and underline icon. Yes, sir. Yes.
And type.
I've learned one too. I don't like what. So let's continue, please. 0.60 squared times what?
3.873.
You don't leave me again. They don't leave me.
Okay, but this is where the problem lies now, because now that means our square root to be cut short. There's problem. Does anybody understand what I'm saying? Now this square root now will be cut short.
You can just
Through
type another square root. Just type
Can you put-
another square root for the next one.
No, no, it's not mathematical.
Just continue like that.
We'll know that the square root covers
The first square root covers.
Just continue, sir.
You just know that the square root covers all of them, please. Thank you. So plus you guys know where 15 is coming from, Abi?
Yes, sir.
Under division of x.
Sorry, I thought it's 3.873.
What is
No. I don't know why person they fear class.
Please, why is there this, please? 1 hour, please. Somebody asked me a very brilliant question. I want the person to ask me again. He said he thought it is what? The person said he thought it is 3.873. Okay, brilliant. That was why when the person that mentioned variance earlier, I was very happy with that question because I knew at this point there was going to be this particular mistake or error. Please, let's note the question is telling you. I gave you when I gave you. Let me just go and check first before I talk. Let me go and check where I gave the list of all those formulas. Okay, I didn't give it there like that. Please, the formula is saying standard deviation squared. Standard deviation squared. We all know that oh God of mercy. What I'm trying to say is, you know that before we did square root of our x, we got p open bracket x minus x squared, which we said that is our variance. Then the moment we did the square root, it turned our standard deviation. This x minus x squared, it's just representing variance. The moment you put the square root, that is when it give you 3.87. If you check that formula that we did, it's x minus x squared that is there now. So that x minus x squared is what is representing standard deviation squared. What is representing x, this qx squared that is in that formula, that's standard deviation x squared. That is just simply representing variance. It's the moment you put that square root that it turns standard deviation. So what I'm simply saying is, what is in this formula, that your portfolio risk, it is variance. not standard deviation. That was when that person that mentioned variance. I said ignore variance there, but here you will need it. I said ignore variance there, but here you have to. So that point before you did the square root is what you need there, not the final answer. If you want to use the final answer, it is that point. You will not, the square will not be there again. It's just going to be QX. That's just what is going to be there. Is it clear?
Yes, sir.
I
No,
need
sir.
more answers. Is it clear?
No, sir.
Is
Excuse
that
me,
no?
sir.
Yes.
Yes.
No, sir, it's
No,
not clear.
no, from my end, no.
Okay, thank you very much. So let me explain again. What I'm trying to say is variance and square root. As variance and standard deviation, that is what is causing the problem here. Variance is the square root of, standard deviation is the square root of variance. Automatically, standard deviation is the square of variance. Abi?
Mm-hmm.
You don't
Okay.
let me
Okay.
write it here. Let me write it here. Now, thank God I know how to do square. So let's say 2. So let's say 2 squared. Let's say 2 squared. This is, I'm just this is like a variance, Abi. But the moment you now do
You
this,
put square root, it will be
the
standard
moment you now do
deviation.
this,
You do the square root.
Quiet now.
the moment you do this, it is not a standard deviation. Leave these two outside, just square root of t becomes a standard deviation. So whenever you want to see a formula, whenever you see a formula that has, in this particular portfolio, that has something like a standard deviation squared, because that QX is a standard deviation. So the moment you have something like this, please, what does this, Jesus, to not work for this? I'm okay, no, it's good now. So this is what I was trying to do, sorry. No, it's not easy to be typed. Don't yawn, no, I'm not yawning, no. We're all in this together. So the moment you see something like this, please, what does this mean? Standard deviation square, it means variance.
Variance, yeah.
It means variance. Whenever you see standard deviation square, and this is our formula, we have standard deviation squared. And in what we solved for security S, where do we have standard deviation squared? That P minus this, that PX minus X bar squared, that is our variance. That is what it means. That is our variance. And in this formula, it is variance that is there, QX squared. That is your variance formula. And anybody still getting it wrong? Okay, this formula, if the formula was WX squared, then QX, no squared, then we would have used 3.87. Because that is them asking for standard deviation. But it is now QX squared, which is variance. I said earlier, if you have if you have 2 squared, it is variance. But the moment you square root it, it is standard deviation. Tony, please.
It's okay.
Tony, your question.
See, please, what I'm trying to suggest, why not just write the value of the standard deviation and put squared here so that they can clear all these explanations?
This square will be too much now. The square root will be too much because we're coming from, this square root covers all. Imagine you now write what? You now write 3 point. What do you want to write? 15 again. Still now put another square. What are you trying to suggest?
Yes, sir. When you square, you see come back to 15 to make the formula easier. Because people will see make this mistake. They won't know the difference between the standard deviation and the variance. So I suggest if you are putting the value of standard deviation, square it. By the time you square it, you come back to 15 so that the formula can be easier to non-mathematicians there.
Okay, question unanswered.
I don't think that your method works, because
I think it's
I
understood
think
now.
if
Because
that's
of
how
that,
it
it's
will make him
understood now.
understand, he should do it for himself like
Please
that.
hold on. Please, please. Hey, one house, please, one house. Please, Tony, I understand what you are trying to say, but what you are saying will not work. But if you feel like that would make you understand, that would not.
I beg go. They carry us go where we don't know.
Please, I've muted everybody. Please, I always say, if I say please, I need an opinion. That is when you should give me an opinion. Please, the class is distracted. So, Mr. Tony, like I said, if you feel like that is what would make you understand. But please be very mindful because that your square root will be too much. You know, you're coming with an overall, look at here. You know, you're coming with an overall square root here. If you now put another square root or square, I feel like we'll get too confusing. Just follow the formula and be very watchful. Whenever you see standard deviation, they denote standard deviation with QX. That's what I gave in the formula, QX, something like a Q like this, QX. If the QX, just know it's standard deviation. But if it's QX squared, it is your variance. It is that simple. If it's QX standard deviation, if it's QX squared, I would say anything squared is the variance. If it's QX squared, it's the variance. And here, the variance we got was, okay, let's still do it like this. If you still don't understand, when you get your standard deviation, 3.87, do the square, you still get 15. It's still the same thing. Please, let's continue. I'm hungry. Please, let's continue. I'm sure we all get it to some points now. Do we understand? The thing is, you will not understand everything here now. Just go and look at it, solve more questions. You'll get it. If you want to get 100% here, this is the first time we are hearing it. So you will not understand everything. Go and check it later, please. So let's continue. Time has gone. So plus
can we continue in the next class?
No,
it's not possible. We're almost done with this one.
No, ma, please, I said let me talk, please. I'm the one organized, I'm the one coordinating this class. When they ask, please let me reply them, please and please. Thank you. So the next one we are doing now is the weight of y, Abi?
Yes, sir.
The weight of y, which is 0.
0.0. Yeah.
Mrs. Shegun, please. Abi, Mr. Shegun, please hold on. 0.40 squared, Abi.
Yeah.
Yeah, snap and send.
I should snap and send. You are not even ready.
Sorry, it's not you, please. My son and his son lesson class.
So 0.40 squared times what's our next one? Our standard deviation.
160.
160.
160.
Hey.
Nobody should tell me 12.
I don't know.
You don't go where you know. Don't tell me 12, please.
Sorry, 160.
160. Then what's the next one? Plus
2.
Plus 2. Then open brackets. What's coming now?
Oh.
The weight of x. Abi?
Yes.
Yes,
Abi?
weight of x.
Weight of x times what is coming next?
Standard deviation of x.
Standard deviation of x.
What is standard deviation of x?
That is the 3 points.
3.87. Are you seeing it now? So this is where the difference is just from. So the next one now is what?
Weight of y.
Weight of y.
0.40.
Standard deviation of y.
What's standard deviation of y?
12.65.
12.65.
This is 5. 12.65. What's our correlation coefficient?
1.
Our correlation coefficient. I know I was saying it that times that don't mix it. What's our correlation coefficient?
That is RXY. That is
the person that said 1, I definitely understand where you're coming from because I said positive correlation. They told you in this question that it's a positive correlation. Just assume it's +1. It makes sense. It makes perfect sense. But please, whenever you're solving your questions, they would most likely give you correlation coefficient. They always give you in the question. I think correlation coefficient is 0.4, is 0.3, 0.2. But ICAN, they might not give you correlation coefficient. They will not say it in your note or somewhere that they will not give you details on how to get correlation coefficient. Now I gave you formula on how to get correlation coefficient. I think I gave you covariance and the like. So they will not come and be giving you details that relates to covariance. Some people in exam will say, this one, Mr. Shile did not tell me anything like covariance. That means I do not need it. Please, if they give you details involving covariance and all those things, know that they want to go and use it to calculate correlation coefficient. So you now go and put that covariance. You use to get correlation coefficient. You now bring your correlation coefficient here. Is there any problem? Are we enjoying portfolio theory? Is there any confusion from anywhere?
Yes, sir. On this portfolio
Yes, sir, there's problem.
What's the problem?
The correlation coefficient that you just explained how to get it.
Okay.
Did you put? I don't know whether it was done in the previous class.
Okay, I would explain that again. Mr. Shegun, please. What was the question? Time has gone with Jesus. Mr. Shegun.
Hello, good evening.
Good evening, sir.
Oh, sorry, it's actually not a question, but I think you haven't actually answered the question. It was for the question that was on the standard deviation stuff. So
Okay.
all I just wanted to say was just since we got the standard deviation and it's squared, so if what the person understands better, 3.873 squared. So I think it leaves it to but you have actually
Exactly the same thing. If you feel like that's the one that works for you, go on. But that one will most likely be confusing because you will not put 3.87 squared, you still come here and put 3.87 again. I don't know, Sha. For me, I don't see it as being okay. But anyways, anyone that works for you. So let me explain this correlation coefficient again, please, for the last time. Please, let's listen. I said, although when we solve more questions, you see how correlation coefficient is treated. They always give it in the question if they want to use correlation coefficient. If they do not give it to you, please use 0. If they do not give it to you expressly, that correlation coefficient is this, they would give it to you in your question. But if I can, they do not give it to you. They are silent about the correlation coefficient. I gave formula in our last class on how to get correlation coefficient. So I said your correlation coefficient is your R equals covariance of X and Y over standard deviation of X and Y. I gave it in our last class. So if they want to calculate correlation coefficient, they will give information relating to covariance. They will give you information relating to your covariance that you're going to use to calculate your correlation coefficient. I also gave formula to calculate covariance too. So if they want to calculate correlation coefficient, they would give you details that you would need. So if you see anything like covariance in your exam, just know that you are asked to go and calculate correlation coefficient. But if they do not put anything like covariance and they do not tell you expressly what your correlation coefficient is, please just use 0. Are we clear?
Hello, sir.
I'm with you, man.
Mine is just from the solution part where you get that 160. I don't know how we arrive at 160. That's 0.40 times 160.
160 is our standard, our variance that we got from Y now, from the first individual security calculation. Please check, scroll up, check what we put in earlier, 160 or what we got for our variance for security Y. Mr. Shegun, you still have another question? And you're still raising your hand.
Oh, not at all. You have answered.
Okay. So
The
please,
150 you have to calculate security for Y, the Y security before you get the 160 as the standard deviation.
Okay.
You scroll up. You already calculated.
Just like we did for
all
X,
this
we do
earlier.
same for Y.
So somebody please give me an answer, please.
I got 42%.
Please, when you are doing this calculation, some of us will like to form mathematician. Please be very careful. This is board mass. Nothing feels okay when we get to option. That's the problem will come with board mass. Please, let's be very careful. Don't go and be multiplying and doing addition before you multiply, please. If you are using good calculator, I always advise, please press everything there once. If you know how to use calculator very well, just press everything there once and for one and move on. This is better because board mass is very confusing. You can go and multiply the one that you're not supposed to multiply first and add the one you're not supposed to add first. So please, my answer, Mr. Adebimbe, please, I'm coming. Let me solve this one first. So please, my answer, please. Or preferably, you can do it side. You do this side first, then you add it to this side. So let's even do it like that to make it easier. So once you give me this first side, the answer of this first side.
Sir, please.
57.29.
Actually,
I got 42%.
The answer for the first side is 2.32.
2.32K.
Yes, plus.
It's not true.
I know.
5.4.
So I know it's not true. It was my
5
answer.
plus 25.6.
What?
5.4 plus 25.6.
I'm lost to my first side. What's my first side?
5.4.
0.4.
5.4, Abby. Okay, so plus, okay, you already calculated everything. Okay. Plus 25. My stuff has cut again. Please manage it for me. Plus 25.6. Okay. So that is not standard deviation.
No.
No, okay. I've used this one. Anything that is not correct, we're changing it to your book.
2.69, sir.
Anything that is not correct, change anything that is not correct, change it in your book. I have used this one, and that is what I will use.
There'll be problem.
Please, what is my plus giving me? What is my plus giving me? 5.4 plus 2.56.
31.
Thank you. Person that gave me that. Person that did not get what you got. You got what? Canada. I'm still coming. Let me just finish it. So what is now my final answer? Yes.
5.57.
5.57.
5.57. 5.57. Okay. So that is our final answer. So that's our portfolio risk. We've done our portfolio return. So that means we practically okay, that means we actually done the question. That means we solved the question. So we solved 1 and 2. Number 3 is an assignment. I've given it. So number 3 is an assignment. Please solve number 3 for me. Objective of portfolio diversification. I actually already explained. I still explained it today. So please solve it and send to me. Please solve objective. Number 3 is an assignment. Please solve and send to me normally now through Word and send to me on WhatsApp. So Miss, hold on, please. Miss Adebayo, please, your question.
Yes, my question is, I'm
Hold
sorry.
on, please.
I'm sorry to bring you back. I don't know how you get 0.
Which 0?
For the RXY.
What are you thinking of using? What do you think we should use?
I don't know. That's why I don't.
Okay, I just want to know if you have another opinion. You use 0 because it's correlation coefficient. There's no information that says about correlation coefficient there. So there's no information. Let me mute everybody again. I don't know. So I said if there's no information on correlation coefficient there, just use 0. But when we solve more questions, you see what I'm saying. They will expressly give you your figure for your correlation. They'll say your correlation coefficient is. They expressly give it to you. If they don't expressly give it to you, but they want you to use correlation coefficient, they will give you details on how to calculate correlation coefficient, which is all these covariance and the likes on how to calculate correlation coefficient. But if they don't give you any details on correlation coefficients and they do not give you anything on covariance, please let your Rx and Y, which is your correlation coefficient, be 0. That's why we use 0. Ma.
Yes, sir. Thank you. Yeah.
You're very welcome, Ma. Any other question, please? So Mr. Pope.
Yeah, don't worry. I want everybody to be done. I just want to take something above, but I don't want to scroll down the class. So when you are done, sir.
Is it a question that will help us? If it's a question that will help us, slow us down.
No, sir.
Figures when you do portfolio.
So, I'm with you, please, your question.
Yeah, I don't know how we got this 5.4. I've been pressing calculator. I'm tired, sir.
I think that is on you now. 0.6 squared.
0.6 square. Get times 15. You will get 5.4.
Actually, do we have any calculator issues? I'm actually I'm not even going to lie. I'm very heartbroken. We are not supposed to be having calculator issues. Exam is me. The moment they dropped that timetable, I had like 6 or 7 new messages in my DM. Plenty questions. You know, people are pressured. It's not even when we should be having calculator issue. Calculator should even be least of our problem. When we get to options, we'll battle calculator very well because we'll be dealing with board mass and all those ND1, ND2, plenty. So that's when we'll be having calculator. All these ones is just simple mass. It's not need out. But anyways, so that is what they asked us to do in the question. So next one, in our next class, I'll come with one more question on this. Then we'll now move to CAPM. And by the grace of God, either we stay here till 12 or we stay here till 1. I do not care. We must finish portfolio training in our next class by the grace of God. No matter, no jazz. Either it's only me and Pope in this class. I must finish portfolio training in our next class. So I'll come one more question on this, and I'll come with what's the name? Then we'll start CAPM, then we'll end CAPM in our next class by the grace of God. Either with 1 and 2 a.m. we'll be here together. So thank you very much for that will be the end of the class. Thank you very much for joining the class. I'm sure there is no question. I will try as much as possible to see if I can send this Word document to the group in case if anybody needs it. I'll still drop it on the group chat in case you need it for anything.
Thank you, sir.
God bless you, sir.
So thank you very much. We'll see you next week, Monday.
Someone is raising their hand that they have question.
I do not see the person. Who is that?
Okay,
Bayemi, do you have any question?
Yes, I have a question.
I like this your voice. So you are not pressured. No exam pressure. Jesus.
I'm telling you.
I'm with you,
Yes, I
man.
have a okay. From the formula you gave, the weighted x squared, then the SD squared. But from what you solved, we
My
didn't
voice is
square
too
the.
calm for me. I cannot even hear you.
Okay, can you hear me now, please?
Yes, I can hear you now.
Okay, we squared the weighted, but we did not square the variance. From the formula you gave, it was squared.
Okay.
So why are we not squaring the variance from the workings?
I feel like you have actually not been with us. But I explained it earlier. I said variance is already squared. That is what is in the question. That is what is in the formula. Variance, standard x squared. And this is, let me show you here. This is the variance here. Without the square roots is the variance. P open bracket x minus x squared is the whole variance without the square root. And the figure for this is 15. So we don't need to square it again now since we're already bringing the square already from here.
Okay.
So we don't need to square it again. But if you want to, if you feel like, that's what Mr. Tony was saying, that if you feel like to get it better, for a better understanding that will suit you, the way we got standard deviation to be 3.873, you can square your own. So if you square it, you still arrive back at 15, but I feel like that would be confusing. Just know the basics, that it's the standard deviation that we got here that we just brought 15, and you don't need to square it again. Because you're already bringing the squared. You are bringing the whole standard deviation, the squared. This 15. Everything on this line is your standard deviation. So that's what we are bringing. It's your variance. No, it's your variance, sorry. It's your variance. That's what we are bringing there.
Okay, thank you, sir.
Let's check for differences with variance and standard deviation. I feel like you understand it better. Any other question? Tony, you said I should do something. I was reading the chat. Mr. Tony, what were you saying? I think he has left. Yeah, he said I should send that kind of question. I already said it now. When we are done with the question, we'll bring like 1 or 2 on portfolio 2 and we'll solve it together. That's how we always do our class. Then you guys go and do the rest by yourself. So thank you very much for joining the class. I really appreciate. I hope
I'm sorry to ask this question. Hello, sir.
Yes, ma'am.
Hello, sir.
Yes, ma'am.
Our total answer is now 5.57.
But there's nothing like total.
Is that
which total
the answer
answer
is 5.57?
Sorry, which total answer first?
Oh, this formula. The answer is 5.57.
Which total answer first?
All the formula that we have written.
For portfolio.
The answer is 5.57.
For portfolio risk, yes, the answer is 5.57.
Yes, sir.
Yes, ma'am. It shocked you. It's supposed to be like 1 million.
It shocked me.
There's a square root here now. Square root would have reduced the value. But anyways, so like I hope I don't have any more questions.
Thank you, sir. I will understand it later.
So thank you very much. Have a good night, Esther. I would see you in our next
Thank you
class.
so much.
Thank you, sir.
You're welcome.
Good night, sir.
Good night,
Thank you, sir. Good night. God bless.
Thank you.
You're
God
welcome.
bless you.
You're welcome.